Hi Titans, thank you for joining us today for another one of our Financial Literacy Series webinars, Loan Repayment. I am your host and presenter for today. My name is Lupe Tinoco Oliveros, and I am the Programming Graduate Assistant at Tuffy's Basic Needs. Now, before we jump into the presentation, I do want to disclaim that I am not a financial advisor or counselor. This presentation contains general information about student loans and loan management. If you do have individualized questions about your loans, I highly encourage you to speak to a financial aid advisor or your loan servicer. Now, this webinar is recorded and it'll be uploaded onto our YouTube channel where you can find the recordings of all of our previous webinars. And without further ado, let's go ahead and begin our presentation. So let's fast forward to the future, right? You passed all of your classes, you did all of the internships, and now you're ready to graduate. So after the celebration and amongst the job search and identifying what you're going to do next, right? You have to start thinking about paying off your student loans. So where does one begin? One important piece to understand about repayment is that when you sign your promissory notes, you are agreeing to repay the loan according to the terms of the note, even if you don't complete your education, you can't get a job after you complete your diploma or your degree, or you don't like the education that you received. The promissory note that you signed when you first received your loans is a legal obligation that you will repay what you borrowed with interest. Now, you do have some time before you have to start repaying, which is called a grace period. If you took out any federal direct subsidized and unsubsidized loans, plus loans or dream loans, then you do have a 6-month grace period. If you took out alternative or private loans, that grace period will vary. The first step is to identify your loan servicer. Although your loans come from the Department of Education, if you took out federal loans, they have various companies that handle the billing and other services of your student loans on the behalf of the Department of Education. It also a tip, never pay an outside company for help with your federal student loans. Your loan servicers are there to help you for free. So if you're ever being charged for any type of service about your student loans, proceed with caution. Now, to identify your servicer, you can call the Federal Student Aid Information Center at the phone number listed on here, or you can visit studentaid.gov to identify who your loan servicers are. The next thing that you're going to want to do is to select your repayment options. So although you may select or be assigned a repayment plan when you first begin repaying your student loans, you can change them at any time and for free. So repayment plans are basically that. What are you going to do? How are you going to pay back the loans? Um, if at any time also you want to change your repayment plans, all you have to do is contact your loan servicer to discuss your situation, and they can help you find a plan that works best for you. Now, there are 6 different types of loan repayment options. The standard repayment plan, where payments are on a fixed amount that ensures your loans are paid off within 10 years. Now, this is automatic if no other plan is selected. It's good to know that you'll usually pay less over time than under any of the other plans, and this plan is the fastest way to pay off your debt. The next option is a graduated repayment plan. Payment plans are lower at first, and then they increase, usually every 2 years, while making sure that your loans are paid off within a 10-year span. It's good to know that you'll pay more in interest over time because you are making smaller payments in the beginning, so you're paying back less. And then with time, that interest keeps charging. But it's a great option for somebody who sees a consistent career promotion as part of their future. Now, another one of the plans is the extended repayment plan. So with this plan, you must have more than $30,000 in outstanding direct loan payments um, that are fixed, meaning that the amount you're paying back will stay the same throughout the extension of this plan. Um, or graduated, meaning that you might start small in the beginning and then increase within the years. But it'll ensure that your loans are paid off within 25 years. It's good to know that your monthly payments will be lower than under the 10-year standard plan or the graduated plan, but you might end up paying more on interest with over time than if you were to pay it off in 10 years. Now, all available repayment plans are going to vary by eligibility of the borrower and the type of loans that you have. So, if, for example, if they're plus loans, subsidized or unsubsidized, your repayment options will probably vary, but you will have all of that information when you go and select the type of repayment plan that you want. Now, there's also income repayment plans. So, and with these plans, you can set your student loan payment at the amount that is intended to be affordable based on your income and your family size. Um, Payments are recalculated each year and they are based on your updated income, family size, and the total amount of your direct loans. And to do that, every year you're going to have to submit proof of these different categories. Any outstanding balance on your loan will be forgiven if you haven't repaid your loan in full after 20 or 25 years, depending on when you received your first loans. And also with that, if you do receive loan repayment, it may also be taxed. Now, you'll usually pay more over time than under the 10-year standard plan because these do go for about 20 to 25 years. But here you have the 4 options of income-driven repayment plans. Now, again, these may or may not be available to you depending on your eligibility and the type of loans that you have. There are also options for student loan forgiveness. For example, public service loan forgiveness is for folks that work with a government organization at any level, whether that be with the federal, state, local, or tribal. If you work for non-for-profit organizations that are tax exempt, or if you have made 120 qualifying monthly payments under a qualifying repayment plan while working full-time for qualifying an employer. So there are many different eligibility requirements for loan forgiveness, and I suggest checking out the website on here to learn more about what that is. There's also teacher loan forgiveness programs. So if you teach full-time for 5 complete and consecutive academic years in a low-income school or an educational service agency, you can qualify for loan forgiveness as well. And I have linked that in this presentation as well. There are a lot of nuances, as I mentioned, to loan forgiveness, but if you see yourself working in a government job, a non-for-profit, or as a teacher, these are options that you can explore and learn more about to see if they can apply to you in the future. Now, the most important thing to remember about loan repayment is to make payments on time. You are required to make payments on time even if you don't receive a bill, a repayment notice, or a reminder. You have to pay the full amount required by your repayment plan because partial payments are not going to fulfill that obligation. Now, student loans are a form of credit. It will appear on your credit report and it can impact your credit history if you do miss consistent payments. If you join me in my Understanding Credit webinar, you will know that making payments on time is the largest sector that determines your credit score. So even one missed or late payment can have a negative impact on your credit score and stay on your record for years. And it's not that I'm trying to scare you. I just do want to emphasize that making sure you make payments on time is one of the most important pieces of loan repayment. So what if you can't pay your loans back, right? Now this is a valid question because there may be times when you might not be able to pay back your loans because as we have experienced, right, life happens. Now 10 to 25 years of paying back loans is a really, really long time. And realistically speaking, there may be times when you just are not able to make loan payments. And that is okay because your loan servicers are here to help. If you're having trouble making payments or are concerned about the status of your federal student loans, you have options that are available to you. First, you can contact your loan servicer to discuss how to get back on track with your payments. They can work with you to change the payment due date and give you a little more time. You can also switch repayment plans to get a lower monthly payment. Uh, or you can get deferment or forbearance, or they can help you with consolidating your loan. So these are all options that can help you or that your loan servicer can discuss with you if you can't make a loan payment. I do suggest to keep their phone number in your contacts list or somewhere in your planner, somewhere where you know you can find it easily, just in case something like, you know, just in case things like these are going to happen, you know who to call and where to call. As I mentioned previously, some of your options will include deferment or forbearance on your loan. So what exactly do these things mean? Now, deferment is a postponement or a payment on a loan. So this is kind of similar to a grace period. Deferment is allowed under certain conditions, so you will need to submit a request and documentation that you meet certain eligibility requirements. For example, if you decide to go to graduate school, you will probably have to have the school send your loan servicers a document stating that you are in graduate school. Now, during deferment, interest does not generally accumulate on direct subsidized loans. However, all other direct loans that are deferred will continue to accumulate interest. Any unpaid interest that accumulates during the deferment period will be capitalized or it'll be added to your principal balance of your student loan. So if you are not paying back that interest during your deferment period, it will be added onto how much you have to repay. And then that can be quite unfortunate because then interest is going to be added onto that interest that accumulated during to your deferment. So it is a good thing to keep in mind that if you are in deferment or forbearance, make sure that you are making at least a couple of payments, if not the full amount, but at least some amount so that the amount that is capitalized onto your loans isn't doesn't add a lot to your principal balance. Now, forbearance is a period during which your monthly loan payments are temporarily suspended or reduced. Now, forbearance is allowed under certain conditions. You will need to submit a request and documentation that you meet these eligibility requirements. For example, you will have to submit documents if you are experiencing a financial hardship or there's probably been a change in unemployment that impacts your ability to pay back your loans. Very similar to deferment during forbearance, your principal payments are postponed, but interest continues to accumulate and even on subsidized loans. So in deferment, usually direct subsidized loans doesn't accumulate, but for if you are under forbearance, it will accumulate regardless of the loan that you have. And very similarly, if you don't pay back any interest during that forbearance period, it will be added on to your loan and it will increase the total amount that you owe. Now, the last option I discussed if you can't pay back your loans is loan consolidation. So if you have multiple student loans, you may be able to combine them into one loan with a fixed interest rate. They will take the average of the interest rates on all of the loans that you are consolidating and give you a new average interest rate. One of the pros to this option is that you will only have one monthly payment that has to be made to a loan servicer, and it can lower your monthly payment by giving you a longer period of time. So for example, in the previous repayment options, you saw that you could have option to pay back within 10 years, 20 years, or 30 or 25 years. If you consolidate your loans, you do have the option of paying back your loans within 30 years. So because of a longer period, your monthly payments could be smaller. Now, one of the cons to this option will be that it will increase the time that you have to repay back your loans, right? As I mentioned, it could be up to 30 years. That could be definitely a con for some people. And because of the added time, you will be making more payments, perhaps an extra 10 years of it, and pay back more interest than if you didn't consolidate them. So there are pros and cons to this option that you will want to speak about to your loan servicer. And I also suggest doing some research on your own before you decide to make this decision. Here, I talked about some options that you have if you anticipate that you won't be able to make a loan payment. Now, what happens if you're late or if you stop paying altogether? Well, the first day after you miss a student loan payment, your loan becomes past due or delinquent. It will stay that way until you repay the past due amount or you make other forms of arrangements, such as talking to your loan servicer about deferment or forbearance or changing your repayment plan. If you are delinquent on your student loan payments for 90 days or more, your loan servicer will report delinquency to the three major national credit bureaus, and it will go on your credit record. And you may also face other consequences, like losing some benefits on your loan or losing your eligibility for future financial aid if you plan to go back to school in the future. If you continue to be delinquent and you repeatedly miss student loan payments, your loan can risk going into default. Because of COVID-19, borrowers don't have to make monthly loan payments during temporary forbearance. Also, no interest rate is being accumulated on your loans, which is a great thing. This is going to happen throughout September 30th, 2021. Now, whenever you don't have to be paying back your student loans is actually the best time to be paying back your student loans because all of your payments are going to be made directly to your principal balance instead of the interest that is accumulated on your loans. So you end up paying less in the long term. Therefore, if you have the means to pay back some of your student loans now, it can make a big impact on your student loans within these couple of months that we are in a national loan forbearance. I have linked various resources throughout the presentation, but here are a couple more. For example, studentaid.gov has a loan simulator that can help you make decisions about your student loans. If you sign on, it'll go directly onto your account and pull up the information about your loans. And it can help you make a best decision, whether it be finding the best repayment plan strategy for you, if you're struggling with payments, or if you're thinking about taking out more loans. I recommend using the modules that they have available on their website. Also, the Office of Financial Aid is a great resource if you have any additional questions about student loans that you have already taken out, or if you're thinking about taking out more in the future. You can see listed on here their website and their hours. Now, there are many aspects and details about loan repayment that I did not get to in this presentation, so I highly suggest taking note of your questions and making sure you contact either the Office of Financial Aid or your loan servicer to make sure that you get your questions answered. That is all for our presentation today. I hope that you learned a lot of information about loan repayment. Now, I want to thank you for joining us. Feel free to email me or Tuffy's Basic Needs if you have any additional questions about any of the content presented here or if you have questions about our services. I hope you enjoy the rest of your day.